It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, David Morgan, the Silver Guru, Keith Schaefer on oil and gas, and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Kelowna at the Coast Capri Hotel, Saturday, April 21st. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
Welcome to This Week in Money. I'm Phil Mackesy. Today, economist Mary Webb on the new Canadian federal budget. Ross Clark looks at gold and silver. And David Skarica wraps up the week in markets. We begin with Mary Webb right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Mary Webb is senior economist at Scotiabank. Mary has been watching North American economic trends for more than 2 decades. She's a chartered financial analyst and author of Fiscal Pulse, which covers federal and provincial budgets for Scotiabank. She's here with us today from Toronto. Mary, good to have you on This Week in Money.
Thank you for inviting me.
Finance Minister Jim Flaherty calling this year's Canadian federal budget modest, almost 500 pages. It's the Economic Action Plan 2012, jobs, growth, and long-term prosperity. I'd get a sense of the numbers here, Mary. The government spending currently $255 billion, or taking in $255 billion and spending $275. That's a $20 billion deficit this year. Now, they figure they can balance the budget. That's the whole intent here by 2015. Do you think, looking at the big picture, that that's realistic?
Yes, in fact, I do. Assumptions have some prudence built in. They have built in a risk factor, given global uncertainty. And the second strategic spending review offers additional cuts to make sure that the program spending restraint is accomplished. So for a number of reasons, including low interest rates, they are getting a big assist from savings on the debt service. And I think we'll see by mid-decade that even if there's a little bit of red ink, it won't be that significant.
Now, this is a fairly significant document. It's 500 pages long. There's a lot of reading. You got to read between the lines a lot, and a lot of the things are not clear. But it's interesting, the contrast here. For months, the media has been focusing on the hot-button issues, mortgages and pensions. And instead of addressing that, the Fed's come out with a plan to eliminate the penny and lower the duty on cross-border shopping here.
Well, that's true. Although typically, the last 3 times that the federal government has adjusted the regulations governing mortgage lending, they've actually done it outside of the budget. It's simply been an announcement. And they really are regulations, not actual legislation. So I think that the minister is waiting to see what happens. We have had total employment in Canada actually decline in recent months, and we are looking for employment growth that falls to less than 1% in 2012, and I'm sure the minister would like to see just what happens to employment before he undertakes any further tightening.
Now, we are looking at an expenditure cut of around $5 billion. Sounds like a lot of money. When you compare it to the $275 billion that is being spent, it's not really that significant. It's, about 2%, I think, Mary?
Well, that's true, and also we don't accomplish that $5 billion cut until fiscal 15, so it is phased in over 13, 14, and 15. But it's on top of the strategic spending review that they did from 2007 to 2010. The fact that they've closed a number of tax loopholes, that in fact they did wind down their stimulus plan, and so we are seeing federal transfers across the country diminished because the stimulus is over. And so I think in fact in total, program spending from fiscal 13 to 15 averages only 1%, 1.6% rather, annually. That in fact, when you take out population and inflation, reflects real per capita spending declines.
Mary, looking at Canada's books with the steely eye of an economist, how are we doing? Are we doing pretty well compared to other countries?
We are, and certainly this budget helps to cement that. But, Canada's had quite a history to live up to. We are known for the fiscal repair that we accomplished in the 1990s and actually for much of the past decade in terms of reducing net debt among our provinces, but also by the federal government. And therefore, the bar was set fairly high. The IMF, for example, has always expected across all Canadian governments for us to be virtually balanced by mid-decade and for our gross and net debt relative to GDP to be turning down. So if we don't meet those objectives, there in fact will be significant disappointment.
We're talking to Mary Webb from Scotiabank here on This Week in Money. Let's talk about some specifics of the new budget and the one that affects a lot of boomers. They're going to start increasing the GIS and the OAS eligibility from 65 to 67. Not a big deal, is it?
Well, it's obviously significant, and they've given us a lot of time to prepare. This particular change does not start until April 1st of 2023, and it's phased in by, I believe it's 2029, over 6 years. So they're giving us lots of pre-warning to adjust. It goes back to how we've adjusted retirement savings in Canada. We've always taken the stiff medicine with a lead time and phased in, but we've done it. And it was the same approach that we took to the Canada Pension Plan back in the latter half of the 1990s, and now the Canada Pension Plan stands out around the world for being virtually fully funded. And so it's important that we keep looking forward and ensuring that these retirement plans are sustainable.
Let's talk about what the media is focused on, and no more pennies. That's going to save the government $11 million a year compared to $275 billion. Doesn't seem a whole lot, but what do you think the government is thinking by phasing out the penny here?
Well, this issue has come up before, and in fact, it's an interesting one because if your transaction, if you don't happen to have pennies, you round up or down, so it'll be interesting to see how it works out. There had been some discussion about whether it would be inflationary and affect the Bank of Canada policy. I'm not sure it will be because one can round down as well as up, but typically the Bank of Canada, in assessing our monetary policy, looks beyond one-time events.
Now, what's the government doing in terms of bond issuing in this budget?
Well, we're looking for gross bond issuance of $99 billion, and that compares to $100 billion last year. It's down sharply from where it was during the recession. Very interestingly, this government we have all the mortgage assets that were put out through the Insured Mortgage Purchase Program, Protection Program, during the recession. They will be coming due in fiscal 14, which means our government will actually have a large source of cash. And therefore, we would look for Treasury bills outstanding, for example, to be drawn down.
Mary Webb from Scotiabank, our guest on This Week in Money. Budget noteworthy for what is not included. A lot of economists think the biggest threat is household debt, but basically nothing in this budget on 30-year mortgages, nothing on minimum down payments, and nothing in this budget on cash-back mortgages. Why did the government back off from this?
I think it's because they see it as an issue that they want to stand to the side and observe, and that's a fair comment. We are in a transition here in Canada, and in the past, public sector employment growth has been one of the key driving factors behind our total employment, our total job creation. Well, not just at the federal level, but also among several provinces, such as Ontario, we are not going to have that pace of new jobs. In fact, there will be jobs lost in the public service. So I think standing back is not a bad approach at all. And the contrasting question would be, can the Canadian economy continue to advance with this level of fiscal restraint in some regions? The answer is I believe it can, partly because of the very major resource and infrastructure projects that are scheduled.
Now, talking about mortgages, the Office of the Superintendent of Financial Institutions a couple of weeks ago came out and said that it would like to tighten lending practices. Are they doing some of the heavy lifting here for the government?
No, this in fact is their role. And what they were saying, really follows practice that is already in place among the major financial institutions, including the chartered banks. It's completely in line with what we already do. I think it was more just setting the formal statement, and this is something in the post-financial crisis that we're trying to do more of, is make sure that everything is structured so that people understand exactly what the rules are.
Lots of interesting stuff in the budget. One of the things that jumped out at me, something I had never heard about before, government wants to make the market for Canadian covered bonds more robust. It's a big market, $25 billion in size. What are covered bonds?
Well, they're a way of financing for the chartered banks, and they use as collateral. Most of the banks, in fact, use mortgages that are insured by CMHC. And therefore, the financing rate is attractive, but it's also attractive for investors because in this era of uncertainty, they offer a very secure product. And it's interesting because when you look at our mortgage experience, Canada's level of defaults and payments in arrears is extremely low compared to many of our trading partners.
Mary, anything else in the federal budget that jumps out at you that you think is significant going forward?
Well, my apologies. You referenced public sector pensions at the very beginning of this interview. I actually think that it's a courageous move on the part of several provinces as well as Ottawa to take a look at those. It represents tough decisions, but the public sector plans have to become sustainable. And so I think that Ottawa did put a number of tough issues on the table that aren't going to be resolved immediately, but at least they're up for discussion. Some
people are calling this a do-nothing budget, and there's obviously a lot in here, and as we mentioned at the top, a lot of things that really you have to look into and study before saying anything definitive. What would you give the budget out of 10?
I never grade budgets, but there are some really interesting shifts here.
Okay.
And one of them that hasn't received too much attention is Canada's always had this long-standing issue of productivity growth and the fact that our productivity growth does not pace the U.S. And we've tried very hard to get all the underlying factors in our macro environment set to promote productivity. So I'm thinking of taxes and reducing regulation and all those things we've worked so hard at over the past decade, and yet our productivity growth hasn't responded as much as we'd hoped. So this budget is actually going to sort of a more micro level and looking at industries and working specifically with different sectors to build trade and open market competition. That whole thrust of the budget is actually going to be quite important for Canada.
Is this something government has any power over?
Again, it's simply setting the framework and then seeing what happens. But I think that when you look at how they're going to restructure their R&D, their research and development money rather, and their innovation funding, that in fact there are significant implications for business.
We are talking to Mary Webb from Scotiabank. On This Week in Money, we're talking about Budget 2012, just came out here in Canada. Another area, Mary, where we expected to hear something and heard nothing, and a lot of folks are thinking about today, those gold-plated MP pensions. All the budget says is that adjustments will take effect in the next Parliament.
Right, but across all its pension plans, Ottawa is going to be looking to move towards a 50-50 contribution rate with its employees. That actually will represent a very significant saving for them.
Now, when's that due to come into effect? Any idea? Good question.
Well, that one, I'm not completely sure. But again, with pension plans, one tends to, and retirement saving ones tends to phase in the changes. And so this is not something that we will immediately rectify, but it is very important that we start to address it.
Mary Webb is Chief Economist at Scotiabank. She is on the line today from Toronto. Mary, we appreciate having you here along with us today.
It's been a pleasure.
Coming up, Ross Clark on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred, 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, mollycord.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Ross Clark from CIBC Wood Gundy is our guest here on This Week in Money. See Ross and his amazing charts at Money Expo, Saturday, April 21st at the Coast Capri in Kelowna, and Saturday, June 16th at the Victoria Conference Center. Register now at moneyexpo.ca. Gold and silver, Ross, pulling back this week, but boy, the end of the quarter has been pretty nice to precious metals.
It has, and we've had a fair amount of volatility, but, we look at after the sell-off into the fourth quarter of last year, I guess gold up just over 6% this quarter, not matching the silver move, though.
No.
16% move in silver. Good move across the board as far as a lot of other markets. You've got the S&P up 12% on the quarter, but not a bad start for the year as far as the metals are concerned.
And the VIX, the index of fear, that has declined. So as we talked about earlier this week, a lot of complacency out there.
Yes, we've sort of thrashed around the latter part of this week. There was a break early in the week, a lot of stocks coming back at the end of the calendar quarter, some book squaring to be done there. Mm-hmm. VIX closing off at 15. So the divergence that we talked about earlier in the week that really started after the 16th of March, that's still in place, and that was such that you had the exchange-traded funds for the VIX trading down to subsequently lower levels throughout the month, while the VIX itself, the actual VIX, measurement of the option premiums, was making a higher low, and that shift in the sentiment there has been something that we've seen around three of the interim highs in the last, I guess it was in the first and second quarters of last year. So it's a sign for short-term concerns up here, the type of thing that you would expect to see after a rally from the October lows.
Mm-hmm. So pull us back to the big macro picture here. What is driving metals and markets? Is it the same thing driving both markets?
Well, we've had we had an all-one market scenario last year. Really, that was very, very present from the May the 2nd high, where everything reversed. But in this year, we're, for all that everything rallied significantly in the first month or so, you're starting to see transitions, equity markets managing to make new highs, but precious metals not. Currencies have started moving in independently, the euro versus the yen. A lot of, finally, I guess you could say, independent valuations that are moving markets rather than all against the dollar. It's all amongst one another, and probably better for those who like to do the fundamental valuations where they don't have to make one big call. They can see where their own work would refine it to finding specific items that have value and others that are overvalued.
Russ, markets seem kind of schizophrenic. You would think, given the background of all this depressing economic information, that markets would be down and metals would be up, but it's just the opposite.
Well, it's you've got a lot of you have to look in terms of the moves that we have had, in terms of the consolidation phases that are happening. I mean, look at the rally in gold that you had from last summer into September. I mean, there was a $400 rally, got way ahead of itself, and we're going through a big, broad consolidation. Moving averages are finally catching up to us, things like the 200-day moving average or the 50-week that I like to follow. Whereas the equity market had been down and dirty and has come back. The overall, I think if you look back over, forget about the dailies or even the weeklies, if you look back over a span of a longer time span, you're still getting upward bias across the board because the value of paper is going down. We've still got governments that are out there with their debt to GDP numbers out of balance, hard assets, even paper assets in terms of stocks doing well, just because governments are printing more and more money. They just don't know how to stop it.
We're talking to Ross Clark on This Week in Money. One of the things that kind of popped out of the financial news at me earlier this afternoon, we're talking about the commitment of traders. Short positions, the largest increase in short positions in COMEX silver seen this year. What can we learn from the commitment of traders figures, and what does that tell us going forward?
Well, the COT numbers, they break down in terms of the commercials and the speculators, and in terms of large and small traders. And so the makeup of that can be quite valuable to us. When you see extremes, that's where any of these indicators tend to be of good value. And what I look at is the fact that the numbers are into pretty good extremes right now. I like the gold market in particular. If we take a look there, the open interest for the commercials, the short positions, was at a significantly high level, not dramatic, but a reasonably high level prior to the leap day scenario that happened here on the 29th of February when we had that $100 break in the gold price. Prior to that, we had a large position, short position by commercials. That position has been reduced now to the levels that we haven't seen in a couple of years. And on the other side of the coin, the speculative long positions were reasonably high and have come off to low levels that we haven't seen since the latter part of 2009. So as of a week ago, those numbers were at what I would consider the outer parameters of their channels. They're channels that we've been in for the better part of the bull market lasting the last 10 or 11 years. And as of this week's rally, just starting to chop around and maybe have a bit of buoyancy in the metals, we're starting to see that the commercials are starting to use this rally once again to reestablish short positions. The specs are starting to come in on the long side, but we're just seeing the very first signs of it. There's lots of room here for things to increase, maybe back to the levels that we did see at the early part of March.
As a retail investor, what should I be doing at this point? Standing on the sidelines, chewing my fingernails, or should I be jumping in there?
Well, the modeling that I had for the metals was that we would have a late February into first week of March high, and then we have two potential lows, one right here in the last week of March. So to have had the breaking gold to reap back down testing support, I see this as a good short-term buying opportunity. I have a series of oscillators that I work with, and when you're in a rising trend, and I use the 20 and 50 week moving averages to establish the underlying trend, when you get oversold, when those averages are still in an uptrend, you want to take advantage of that condition to be a buyer. We're into that position as of now. How far we rally out of here, nobody really knows. We'll see what the markets are capable of. So, but cyclically, there's a low here. There's another one in my work that comes in at the end of May, first week of July. And I would say that if we can manage to plateau in gold here in the 1600 to mid 1700s and hold reasonably well, that coming out of that low in May, June, you could be looking for an exceptionally good market on the upside. Be looking for new highs on the year, probably well before the end of the summer. If the consolidation that we have, if the bounce out of here turns into a consolidation with a more negative bias, then the second half of the year probably just is going to work its way back towards the 19 and a quarter level. We've got to take each one of these items as it unfolds rather than try and build too much of a scenario for now. But at this point, oversold conditions are appropriate, I think, for the bullion. And in terms of the stocks, whether you're looking at the juniors or you're looking at the Huey, the large cap names in the sector, the oversold readings there, most of these indices are right back down close to where they were at the December low. So oversold, due for a bounce. I wouldn't look at this as a buy and hold for the long term as much as I would look at this as an interim trading low.
Ross Clark from CIBC Wood Gundy here with us on This Week in Money. We were talking earlier about the juniors and the seniors, and they seem, at least to me, pretty cheap relative to gold itself.
Most of the readings that I do of the analysts on the fundamental side, they're seeing that the stocks at this point are at levels that basically haven't seen. No, this is valuations relative to bullion since either the 2008 lows or back even into the 1990s. So when we end up seeing the eventual strong turn to the upside in the metals, I think there will end up being a large catch-up as far as the stocks are concerned. It's not unusual for the stocks to languish well beyond what you would anticipate to be a reasonable time frame, but valuations eventually get to a level where there is a catch-up. And we've talked about over the last year that these floor levels, as far as the metals are concerned, become very important then when valuing the stocks. Right now, you've got a major floor in gold, happened back at the 680 level during 2008, and you've got a series of minor lows that have happened on the way up. You had like around 1050, again about 1250, and now we've got this 15 and a quarter level that's been holding for the last 6 months. If we can punch through to new highs, my thought is that the valuations on the mining stocks will no longer be pushed against the $680 to maybe $1,000 floors for gold. They will be based upon that 15 and a quarter level that we've now been putting in. If that's the case, there's a lot of catch-up.
Sounds like a great opportunity. Is there anything that could go wrong that could jeopardize those predictions?
From a technical perspective, we take a look at trends to say what's important. For me, 16 and a quarter is important on a short-term basis. Short-term being the next 2 months. Okay. Because if we hold that, we've held 60% of the advance off the December lows. If that's violated, I think you're probably looking at us taking out the low of the year, but numbers maybe in the high 1300s, 1400s could be taken a look at. In terms of what could hit the market, if you were to have a significant rise in interest rates, which I just don't see that on the horizon, you could have a minor rate rise would not have, I think, a dramatic effect. A major interest rate rise would. If somebody was to figure out how to balance all of these international budgets that we have with Europe, etc., you could gold would probably fall out of bed, but that's not going to happen.
Ross, you're going to be at Money Expo Saturday, April 21st in Kelowna at the Coast Capri, and Saturday, June 16th in Victoria at the conference
we'll be showing a number of the charts, trying to give people the parameters to work with, and I would suspect as we get out into the middle of April, there'll be even more clarity for the analysis.
Give us a quick sneak preview of what you're going to be covering at the Money Expo shows.
Well, we touch on the equity markets. We'll be clearly looking at the energies, precious metals as well, and we've got some graphics that I think people will enjoy, and it takes us the better part of a half an hour to run through things. So we look forward to seeing them.
Always interesting, and what I like best about what you do is that you are available to folks to talk to after the show and pick your brain.
Oh, I always stick around, and I always enjoy talking to the public.
Ross Clark at Money Expo, Saturday, April 21st, Kelowna, Saturday, June 16th in Victoria, and you can register now at moneyexpo.ca. Ross, it's always good to talk to you. Thank you, my friend.
Look forward to it.
After the break, David Skarica on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
David Skarica is author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find Dave on the internet at addictedtoprofits.net. Dave, always good to have you back on This Week in Money.
Yeah, thanks for having me. You had some problems getting me this week, but I'm here.
You're down in the Bahamas. You're having a great time down there, and the connections, of course, are not 100%, but we have to live with that in today's world, right?
Yeah, hopefully that'll be taken care of in the not-so-distant future, but for now, yeah, I got to put up with a bit of it.
Let's look at what happened in the markets this week. We kicked off the week with Fed Chairman Ben Bernanke talking about employment, and, of course, the market read between the lines that interest rates are going to stay low. We had the biggest one-day gain for the Dow so far this year. Pretty cool.
I think when you look at the interest rate thing is that they're just going to keep rates as low as they can, as long as they can, just because they have to. One of the problems with interest rates is this. The U.S. national debt is now $15 trillion.
Wow.
And I actually worked it out, and I found that the interest payments that they're paying right now on that national debt are the same now as they were in 1996, despite the fact that the national debt was under $5 trillion back then.
Oh, that's interesting.
So what basically happened is they have to keep rates low, because if rates were, say, where they were in 1996, it would eat into so much of the budget that they could not afford. They'd have to make $500 to $600 billion in cuts almost overnight. So they're just going to try to keep rates as low as possible. And obviously, we're going to continue to have a jobless recovery, because I don't think the right wheels are in motion to really have proper economic job growth.
Now, Bernanke did not really say much new other than that he was still confused about what's going on. But it's really all we needed to wrap up a pretty good quarter for markets, right?
Yeah, I think like when you look at the markets is like the one thing is you have to separate somewhat of the economy from corporate profits. And as long as we have some demand in the economy, we've seen that corporations have really streamlined themselves since the 2008 financial crisis, and they're in pretty mean machines right now. So as long as we don't see the bottom fall out, we can continue to see strong corporate growth. And I think one thing you have to look at going forward that may even help markets even more, I think we're going to see a correction. But after this correction, as I'm looking for China and India to begin to loosen monetary policy in the second quarter.
Now, looking at these numbers, it's surprising that you wouldn't be looking for a correction. Listen to some of these numbers so far. The Dow, so far, year to date, up 1,000 points. S&P, largest first quarter gain in more than a decade. The NASDAQ, up almost 20% year to date. That's pretty sensational.
Yeah, that's really, really strong numbers. And obviously, if you kept that up for every quarter, you'd have an over 40% gain for the markets this year, which is, in all probability, not going to happen. So, and seasonally, as you know, there's that old sell in May and go away dictum. So I would think that we're going to kind of see the markets maybe hold up into that period. Might pull back in April during the earnings season, but then see another move higher, and then kind of see the seasonally correction over the summer into the fall.
David Skarica from addictedtoprofits.net, our guest here on This Week in Money. And a couple of warning signs that we're always kind of scratching our heads about, Dave. Maybe you can help us on these. Insider selling, it has reached kind of alarming levels. What do you see happening there, and why is that important?
It's a tough indicator, because insider buying was very high in the summer of 2008, and we saw a tank in the markets into the fall of 2008. And we saw very high insider selling last year, and that did not lead to a big collapse or decline or anything. Mm-hmm. So I think that's a negative sign and a warning sign, but I don't think it's something to just start running the hills for because of that. I think one key aspect of markets this year is something like 40 to 50 elections around the world this year.
Okay.
So because of that, you're going to see very loose monetary and fiscal policy, and you're going to see politicians and governments do everything they can to prop things higher. So I don't think you can ignore that.
What about the fear index, Dave? The VIX, it is down to 15 from almost 30 just a short while back. Are we getting more complacent? Are we too complacent out there?
Yeah, I definitely think there's a lot of complacency. But if you look at the VIX, see, the history of the VIX is you have the big spikes, like you had last year, when it went over 40. And then when you see the rallies and you get complacency, you can, unlike the spikes where the spikes maybe last for a few days or a week or two, the complacency can last for weeks or even months before the market really rolls over. Mm-hmm. So I think that's a sign of complacency, but it's not a sign that we're going to top tomorrow. Topping is a process, and the VIX being low could be a sign that we're in the beginning of that process, but this could take a long while to do that. And when you're it's hard to know when you're in a bull market because, let's look at, for example, the mid-90s, in 1994, 95, 96, the VIX actually almost made it down in single digits. And, of course, that was the start of that major bull market that lasted to 2000. So I think you always have to take these indicators with a grain of salt.
And another economic indicator, we had some good economic news this week, maybe good economic news. The U.S. economy appears to be recovering. Commerce Department said spending rose in February and consumer sentiment climbed to its highest level in more than a year. And I guess those aren't really economic fundamentals, but it indicates the mood of investors out there, does it not?
Yeah, I think part of the Fed's idea behind the low interest rates that we talked about earlier is they want to recreate somewhat of a wealth effect. Now, with higher unemployment, there's not as many people in the market as there were in the 90s, but obviously with the top 5% of people owning so many equities and the kind of a trickle-down effect, when the S&P goes to 13 then 1400, that helps that kind of wealth effect in spending and, kind of it trickle-down kind of theory. So, no, I think you're going to continue to see that. My opinion is still somewhat of a deck of cards. They're going to try to prop this up into the election, but at some point, in probably, I think more like 2014, we're going to see a big spike in interest rates as there's debt numbers that are so enormous in the States start attracting some attention from the bond vigilantes. So I'm not a doom and gloomer, but I'm also pretty realistic that this is not a real recovery. I don't think we get a real recovery until they really begin to cut government spending, until we see a rise in interest rates to kill off inflation. So to me, this recovery still may last another year or two, but there's still going to be another downturn coming.
We are talking to David Skarica from addictedtoprofits.net here on This Week in Money. Oil usually strong, Dave, into May, but it is down this week to just over $100. Do you see oil in a downtrend of some kind here?
We definitely had a lot of speculation in that market, and entering the summer quite shortly or spring, we usually peak ahead of the seasonal summer driving season, so we could see a consolidation. But I'm pretty long-term bullish in oil. One of the major aspects is even though demand is down in the States, it's not falling apart, because that's one of the countries in the world that has absolutely no energy policy. It's actually difficult to fathom that, when we had this energy crisis in the 70s, Brazil decided to produce half their power from ethanol, from a sugar-based ethanol. And now they've done that. You go to Brazil, you see gas stations have the ethanol price and the gas prices, and many cars are dual engined dual gas tanked and the whatnot. And in the States, there's absolutely, even though you get the Pickens plan sitting out there, there's no plan to move away from oil because the oil lobby is so large. So I really can't see oil falling that much. And people don't ever look at monetary policy when it comes to energy prices. It's not just speculators. It's not just supply and demand. You're printing money. You have zero interest rates. That money has to go somewhere. Yeah. And I'd rather buy a barrel of oil or futures contract than buy a bond that yields 0.5%. And that's what happens when you dislocate things with artificially low interest rates.
More with David Skarica next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're back with David Skarica on This Week in Money. How's this for U.S. energy policy? Rumor this week that the U.S. could tap into its strategic petroleum reserve, and they hope that by doing that, they're going to push the price down. Is that realistic?
That's like having a hangover, and then you decide around noon to have a couple beers because it makes you feel better.
Sure.
So that's not going to work, because at some point you're going to tap out your reserves of booze or or gas or whatever it is, and then you're just going to crash. So meaning that, like, at some point, you may do that short term to decrease oil prices, but then they're going to keep going back up afterwards. So that's a useless, short-term, politically motivated nonsense.
Americans certainly feeling the pain this week. A gallon of gas in the States, almost $4 after practically about 3 weeks of consecutive daily increases.
Yeah, but see, does anyone care? Because I always think excuse my language, I think a lot of Americans are a bunch of whiners when it comes to that. Because, you're in Canada, I live in the Bahamas, where we have about same gas tax and same gas prices. Here it's like $6 a gallon.
Yeah.
Where you live, it's probably about $1.30, $1.40 a liter. Mm-hmm. Which equates to about $6 a gallon. That's or right. $5.50 to $6 a gallon. And so no, just because they have this archaic system where they have these suburbs that are based on the automobile, and people drive so much there, they feel the pinch than a lot more other countries. Like if Europe has a great high-speed train network, and even if you live in a city like Manhattan or Toronto, which have say good GO train or subway systems, you don't have to drive as much. You don't feel the pinch quite as much. Mm-hmm. So the problem is that you have this system in the U.S. that's based on the suburbs and cheap oil and gas, and the suburbs were built in the 50s and 60s, and it's not going to work with today's economic reality of permanently higher gas prices.
We're talking to David Skarica from addictedtoprofits.net here on This Week in Money. Gold and silver pulling back a little this week. Gold down from its peak of almost $1,700. Silver was at $33. It's also pulled back. What's going on here?
Well, I think you look at silver, and I've said this before on these interviews, is that silver's in a long-term consolidation. We saw a huge spike in the first quarter of last year. Silver went to 50, basically tripled in about a year, and we need to consolidate those gains, and that still may happen for another 6 to 12 months. So that silver in the low 30s does not worry me at all. Even gold here had a big similar spike, not quite as extreme, but went to about 1,900 last year. I think we need to consolidate here until maybe a significant move higher later in the year. But I think with a real opportunity here, and I sound like a broken record, are the stocks. The HUI is trading at 472. The HUI to gold index is 28%, the lowest since the financial crisis of 2008. PEG ratios, price to earning growth ratios, of many of these stocks are 0.25 to 0.50, meaning that their price of their stock is underperforming their earnings growth by 100 to 200%, meaning they're very cheap. So I would really look at some of these stocks, and these large cap stocks and junior stocks that are very, very cheap at the moment.
Are we still
pricing themselves in for 12 or 1,300 gold, not 17 or 1,800?
Yeah. Are we still seeing that divergence between the senior and the junior gold stocks?
Yeah, I think actually we're going to continue to see an uptick or an increasing strength in the junior stock. Now, I like the seniors here because they're so cheap, but I think I like the juniors more, and the reason being is if you look at the juniors, you've seen a lot of senior gold stocks who have problems with one of their properties and they have to cut production or raise prices. I think investors are starting to realize, it's easier to run a smaller junior company that has maybe one or two properties to maintain than a larger senior company that has dozens of properties. Now, like I said, the seniors are okay here because they're just historically so cheap. But if you're looking for more bang for your buck, and the juniors are still cheap as well, I would definitely look at a nice junior gold or silver producer or exploration company that has either a potential to have a mid-sized property expand in reserves, or a small producing property that could be a takeover target by a senior.
Are we still seeing that seasonal aspect in gold stocks, David, that they top in spring and then bottom in summer?
Not really, because they're trading near multi-year lows and it's March. So I could. Now sometimes they have. If you look at like 2004 or 2005, there have been times when they have bottomed in the spring. Or like in this March-April time frame. So we might be seeing that again.
Dave, for folks who are interested in your newsletter, how do we get involved?
Yeah, if you go to www.addictedtoprofits.net, I have a special I'm going to keep on for a while, where if you buy a subscription to the newsletter, you'll get the free month. So you basically get 13 months for the price of 12.
Okay.
And if you just want to sample it, I have a free version of the letter, which you can sign up for. And every week I send links to articles and interviews like this that I do, and you get a kind of feel for my work.
David Skarica is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find him online at addictedtoprofits.net. Dave, thanks for talking to us.
Thanks for having me.
Our thanks to our guests, Mary Webb, Ross Clark, and David Skarica. And thanks to you for listening. I'm Phil Mackesy. For AmericanManganeseInc.com, we're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.